Hi there, and welcome to another episode of the FSBO Smarts podcast. On this podcast episode, we're going to go into the real estate investing, and we're going to do a deep dive into strategies and the stories behind achieving financial independence that others have used, and hopefully that you can use and adopt some of these examples on your own real estate investing journey. So stay tuned for that. I'm your host, Steve Klein. Today we're going to talk about the incredible, powerful path to financial freedom with real estate investing. So let's get into it. Hi, this is Steve Klein with the FSBO Smarts podcast, bringing you the best tips, tools, and techniques as it relates to for sale by owner, either with your personal residence or your investment property, so that you can save tens of thousands of dollars on your next home sale and become FSBO Smart. So this episode, we're specifically speaking to investing in real estate for the long haul, for 15, 20, maybe even 30 years, so that you can use it as a retirement vehicle and preferably 15 to 20 years be financially free. So specifically, we're focusing on the 15-year plan to achieve financial freedom through real estate. Now, if you've ever wondered on how this whole thing works with leveraging property to build long-lasting wealth, well, this episode is for you. Now, before we dive in, let's set the stage for financial freedom and what that means. It means different things to different people. But at the core of it, it's about having enough income to cover all of your living expenses and not needing to work a traditional job. And it's all about having control over your time and your financial future. Now, whether you're dreaming of retiring early, traveling the world, or simply have enough time to spend with your family, your friends, and your loved ones, financial freedom can make all your dreams a reality. Now, there are many paths to financial freedom. There's stocks, there's bonds, there's business portfolios that you can start. But today we're focusing specifically on real estate. Now, why real estate, you ask? Well, let's consider its historic stability and growth over time. Now, unlike other investments, real estate has tangible assets, and that has consistently appreciated over time. You can also leverage that, which means that you can borrow money to purchase these homes at a fraction of what it would cost. Now, you pay that off obviously over time, but the property itself can generate income as well, especially if you rent. Now, one of the biggest advantages of real estate is the estate's cash flow. And by that I mean the tax or the rental, and then all of the other stuff. Now, speaking of taxes, property taxes do play a role in renting a property out, because you have to kind of take in consideration the insurance on that house, the taxes and the property that you're renting. Also, maintenance. Maintenance is a big consideration. But what I could tell you is that once you've got all those things mapped out, a lot of people will use that as a positive cash flow. So let's just say that you're renting a property for around $2,000 a month. You may be paying $1,300 for the principal and interest on that, another $500 a month for escrow, and then maybe, another, say a couple $100 for insurance and maintenance. It adds up to almost $2,000. You may be breaking even. Or if it's lower than that, let's say it's $1,800 total, then you've got $200 positive cash flow. Now, I know that doesn't sound like much, but it's a great big deal when you have someone that's in your home paying the mortgage for you with your rent. You're providing them a place to stay. They didn't have to put up that down payment like you did. So you're taking a lot of the risk. But, and of course, maintenance, cleaning fees, things like that. You have to maintain that property. But over time, that's going to go up in value, preferably, hopefully. And you can write off a lot of the expenses if you're running it as a business. Now, again, you have to check with your tax accountant or an attorney for the details on that. But 9 times out of 10, owning a real estate property for the long haul is the way to go. Now, this positive cash flow is a steady income that can grow over time. Plus, properties tend to appreciate. The value will always go up, usually. And as that steady increase goes up, so does your net worth. And let's not forget the tax breaks. You can deduct the mortgage interest, property taxes, and other expenses, which can be a significant reduction on your liability. Again, check with your tax account for all the details, but the tax accountant will give you all those details. So how do you get started in this 15-year plan to financial freedom through real estate, you may ask? And just how does this all work? Well, let's break it down. This idea came to me when I knew a few friends of mine, both who have done this. They did this model, purchased their homes, rented them out, and eventually they retired early from just real estate investing. And they did it all within 15 years. One guy did it within 20 years. Now, full disclosure here, I did not implement this plan or this model on my own. And I'm not a financial advisor by any means. I work in the high-tech field, and that's where I made my money in the high-tech world. Now, I did dabble in real estate investing, and I've sold my own home for sale by owner, as you know, and part of the reason why I have this channel. But I have used these techniques in my own investment journey, and it's very helpful, so I want to share those with you right now. They help me amass equity in my own homes to add more to my bottom line of my real estate investing and my real estate investment journey. And I'm going to give those to you right now in this podcast. So get ready to take some notes. So here we go. Number one, step one is to purchase the home within your price range. Now, I know you're saying, well, that's pretty basic, right? Well, at first, you may need to be able to purchase the home by yourself. At first, you may feel like you can't. Now, much of this depends on your financial situation and if you have some extra cash that you want to invest. So if you have some extra cash that you can invest, you may be able to get an investment property. Just know that there are different lenders' requirements, different lending requirements based on if the property is your own personal residence or if the property is going to be for, let's say, a commercial use, or you're going to rent it out. Your LTV, or loan to value ratio, typically is 70 to 75% in those situations, meaning that you need to come up with 25 to 30% down payment on that house if you were just going to buy it for a rental. That's a huge deal when you're first doing it, but so when you buy your first home, you may not be able to do that. And this is the main reason that first property home buyers purchase it on their own, because the main reason is the LTV of your own is typically a lot less, like 20%. But sometimes you can get a special FHA loan, which is only like 3% down. You have to check in your area, 3 to 5 to even 10% down. Now, step two, remain in your home for at least a year. Whatever home you buy, it's critical that you stay in there and become stable. The banks want to see a stable payment on that house, and to know that you're a great borrower and that they can lend you more money. This is building your track record. Now, it's preferable that you stay in your own house and live there for at least a year, like I said, and you could pull cash out. But remain in there because 9 times out of 10, your property is going to increase in value even in the year that you're there, barring any economic downturn, of course. Now, there's a lot to consider when you're first buying your first home. Let's just say that you buy a fixer-upper and the seller gives you $20,000 discounted so that you can do all those repairs yourself and they don't have to be hassled with doing those themselves. And so they give you a discount, you get $20,000 off. Now, let's say that you do some home improvements. You take all that money that you would have saved and you put it into paint or repairing the deck or the roof. And all of a sudden now, that $20,000 that you invested, or rather that they gave you to invest in that home, becomes an exponential increase of $50,000. Because you see, even though they discounted they discounted it for $20,000, by you putting money and improving it, it'll actually become more. I've seen that people that put $10,000 or $20,000, it has an exponential increase to the bottom line of that house or the appraisal value. So for example, if you put in that, say, $10,000 or $20,000, well, you could actually see $30,000 of actually true appraised value increase to that home. Now, a lot of this depends on what you do, right? What you did to improve the house. Some of the aesthetics, believe it or not, just painting can increase the value. And don't forget, you had a whole 12 months. So over time, that property is actually increasing in value. So that $20,000 that you actually took as a discount may have increased by $50,000 in the following year. So keep that in mind when you're buying your home and staying into it. All right, so step 3, rent your home out. Now that you've been into it for a year or two, this is the time where you want to start looking for renters. See if your house can be rented in your market at a pretty decent rate. And then once you have someone that signs a contract and moved in, it's time for you to move out. Move out with a friend. Basically, you're going to become the property owner and a landlord, but now you're homeless, right? Because you need a place to stay. You gave them a place to stay by renting it out. And it was a win-win because they didn't have to come up with the down payment, which is huge, by the way. And you already did that for them. Now, this is the tough part as well because there are laws, a lot of new regulations lately, especially in America, that have not been favorable for the landlord. So just be on the lookout for that before you invest in any property or take your own personal residence and make it a rental. Just be aware of that before committing. But it's a great way to build your portfolio of properties and at the same time help someone out in the process. Now they get to live in a house with hopefully a backyard and you get money for it. So step 4, use the equity in house A to buy house B. Now that you are renting out your home, you need another home so that you can live in again. And basically, this all points back to doing step 1 again. Buy a new home for yourself and then build up the equity in that second home as you did with the first home. Now, it's a good idea, maybe even before you rent out your first home, to pull any money, any equity you have in the form of a second mortgage so that you can use that funds that's already being paid by the renter. You can use that to fund your other project or your other house. Even if you have to pay a little bit extra above and beyond the rental, whatever the rent is, that's worth it to you, right? Because then you can get into your next home. Just look at the budget and see what works best for you. So step 5, repeat the process again. Go back through step 1 through 4 and just keep repeating this process until you get up to 15 to 20 homes. Now, a big note here, you may not need to move after a certain point. After a certain point, you're going to get a portfolio. Remember, we talked about the portfolio of houses. You're going to get such a portfolio that you're going to be looking really good on paper to the banks. You're going to look like a true real estate investor because you're going to have, 5, 10. I usually find it around the 7th house is where banks go, okay, this guy knows what he's doing. He's got income from these houses or he's breaking even. They look at this as part of your income. And now all of a sudden it's not just your W-2 or if you're a business owner, your whatever income you're getting from your day job. They also look at this as passive income that's coming in from your rental properties. Now, obviously, some of them you may have a little negative deficit. Maybe you're paying one, which we don't recommend, but say you're paying $100 to one property, but maybe the other one you're making $300, so you're making a total of $200. Or let's just say you have 5 properties all making $200. So what's that? $268,000. So you see where I'm going with this. The more rental properties you get that's having a positive cash flow, the better the banks are going to respond to you when you get your next loan, and then you don't have to keep moving. You'll probably want to settle in on one of the houses that you've purchased wherever you feel comfortable living. And that'll become your main residence while you're going through this process of retirement from these real estate investments. The reason this works so well is that your portfolio is building it up to sustain you. It's building positive cash flow that will sustain you throughout the years as you keep growing your investment portfolio, and it just keeps building upon itself. Plus, the banks can use these properties as collateral for the new homes that you buy in the future. Again, check with your banks on this for specific situations that you may be in. So anyway, let's go to step 6. And this is what I call the 10 for 10 rule. So in step 6, we want to get 10 properties, 10 years, and we want to use that to build up and pay down the 10 worst properties or the worst performing properties or the 10 properties that give you headaches. So you're saying, okay, wait, what's this all about? So what we're going to do here is, now that we have our portfolio of houses, and it may have taken us 5, maybe 6 years to accumulate this, maybe even 10 years, we want to, at about the 10-year mark or the 15-year mark, we want to look at all the 20 properties. Let's just say we own 20 properties. We want to look at 10 of them. And whatever 10 are not performing or giving us the most maintenance headaches, we want to look at removing those from our portfolio by paying them off. And you're saying, okay, well, Steve, how do I pay them off? Well, we're going to sell them. Within 10 years, you should have a significant growth in those houses. And what I've seen happen is the amount of equity that will increase because you've also been paying down the loan, be it a 15 or a 20-year mortgage, you'll have those houses about half paid. And if there's equity also increasing, then you'll get a pretty good chunk of money out of each one of those. So the bottom line is you take the money that you got from those 10 properties and pay down the remaining 10 that you still own. You're still renting them or you live in them. And by doing that, you are solving your problem. You're actually reducing the amount of debt you owe on the remaining ones and increasing your retirement funds. Now, when I say problem properties, I really mean problem properties. You want to get rid of those properties that are not doing you well, that you have equity in, and you want to start cashing in on those. And you just want to look at the properties that are maybe underperforming. So just do that as a kind of a ballpark or kind of a task that you want to do. Now, there are scenarios that I could go into, such as the 1031 exchanges that you might have heard about when selling a home and exchange it for another one to avoid taxes. Again, I'm not a tax accountant, and that's my disclaimer. So check with your local tax accountant to see what's best. But I've seen this time and time again as a way to help snowball the investment strategy into retirement for people that own real estate. Now, I should point out before I go on to step 7, some people use that money and buy another, like a multifamily unit, be it apartments or things like this, commercial real estate. You can do whatever you want. I'm just saying that if you do, again, check with your tax accountant, check with an attorney. There might be avenues that you can use the 1031 exchange for that as well, and avoid the capital gains tax that you would have to pay otherwise. So let's go on to step 7. Step 7 is payday, retirement. Somewhere between year 15 and 20, depending on the terms of the mortgage, you should have enough accumulated, and some of your mortgages nearly paid off from the previous homes that you sold. And you can do one of two things. One, you can keep the properties and rent them out and just live happily ever after. Or second, you could sell those houses and put your money into a IRA, preferably a Roth IRA or some other IRA that you can then use and pull funds from. So let me give you an example. Let's say every house that you own, the remaining 10 were $350,000. And that's being very generous, considering that the houses could have gone up exponentially. They could have gone up like tremendously, right? Maybe it's not 350, maybe it's 600,000 by the time you sell these. But let's just, for this example, say it's 350,000. So $350,000 times 10 is $3.5 million. Now that's like you're instant millionaire, right? Well, that took a lot of hard work, and these days, anyone that has a retirement account is considered a millionaire, so it's not as big or glamorous as it once was. But when you think about retirement, you usually have a draw of about 4%. And so if you think about that, let's use my example. Let's say that your cash on hand at the end of being all of these sales is $3,500,000, and those are dollars. Now, typically a 4% draw for retirement would make that $140,000 per year. Now, if that's enough to live on, comfortably, then you've made it. And most people can live off something like that comfortably. And again, these prices may vary depending on your situation, but I'm sure that you're probably saying right now, well, Steve, that sounds amazing. I mean, how can I get started? Well, there's some considerations that you need to be aware of when starting this journey of real estate investing, especially when you're buying and holding real estate assets as a retirement vehicle. First, you need to be set up for success. Set yourself up for success means make sure you have the down payment, making sure you have a team that's around you for maintenance. That could just be yourself and a couple other people. Make sure that you aim to get that 20% down payment so that you don't have to pay any mortgage insurance. That actually is a lot better if you could do that. Research your real estate market, look at your neighborhood, and make sure that you're in an area that the rents are in demand. Good school, potential growth, things like that are really important. Make sure you're not in an area that is really preventing real estate owners, landlords, from making a profit, and that they won't be under undue scrutiny. That's really important. Now, if you don't have the time, you need a reliable real estate agent, someone that's a savvy mortgage broker, and also a property manager, especially if you have 10, 15, 20 properties. It may get too much to manage. It's let alone having all these keys at your disposal. It's kind of tough. Now, my wife and I used to manage apartments years ago, and we know the struggles that it could come up with property management. So it's really good to hire a good property management firm to help you with these rental properties. Another note is once you have your first property, it's time to scale up. Use the rental income, and like we talked about before, any equity you built up, you can purchase additional property, refinance your properties, and use that for the new investments. And this will ultimately reach your portfolio goal, because that's what we're trying to do here. We're trying to create this real estate portfolio where then you can ante up and have enough money so that you can retire off of all of your real estate. Effective property management is the key though. And I always say that look around, make sure that you get reliable property managers that maintain your house, make sure that things that go wrong like a water heater or things like that, that they're readily available to repair those at a cost-effective price. You don't want to go broke because of your property management. You want to make sure that they're keeping in communication with you at all times. Finally, make sure you've got adequate insurance on your properties. I know that normally when you buy a home for yourself, you're getting it just for yourself. But if you have insurance for your houses that are being rented, you may need a landlord or a renter's insurance on that home. So just keep that in mind. But hopefully these tips and these strategies that I've spoken about today can kind of open your mind up and really think of the possibilities. I know 2 people firsthand that have done this, and they've retired and gone off to do other things in their life, and it's really cool. A lot of it hinges on, of course, that mortgage. And if you got a 30-year mortgage versus a 15-year or a 20-year mortgage, it can add undue time to paying off that loan. So those are things to consider when you're doing this strategy. But this is a really effective strategy, and a lot of people have used it to retire early or just buy and hold real estate assets for the long haul. And hopefully these tips can help you reach your financial goals along your journey in life. Well, hey, this is Steve Klein. Thanks for tuning in. Hope you had a great time. I hope you have a great Thanksgiving. Tune in for our next episode. It's going to be around the holidays, and we're going to talk more about this fun and fascinating world of for sale by owner.